Welcome to your first quarter 2026 update. As you see, I have my son Andrew, who also is, a big integral part of what we're doing, sitting next to me, and he's going to talk to you a little bit later in this video. He and I work well together for several reasons. One, I'm about macroeconomics. I look at the big world picture, the bigger picture. He's a microeconomic person. He looks at the details of a company and things that I kind of shy away from. So we're very good in complementing each other, and it's really shown up. I think our results are better as a result of it. The other thing Andrew has done is he has created tools using AI that we're involved in now that is really, it's incredible stuff. And, my hat's off to him. But I wanted to kind of talk to you about what's been going on with your money. There's a war going on that I'm not so concerned about the war or any its effects. I don't think that's going to end up being any big thing other than we got to replace a lot of armaments that we've used, which is, we're invested in those companies doing that. But the barrel of oil is a big concern for me. Always will be, always has been. And the reason is that it's like a tax. People can't afford when they have to spend too much for fuel for their vehicle, and it really has an impact on the economy. So when oil goes below roughly $50 a barrel, I get concerned for the energy producers. When it goes about $90 and starts elevating to getting over 100, I get very concerned. So on March 12th, I took some action and we pulled off some positive gain positions that we've had for the year. We locked in some gains and we pulled those aside, and we were at the highest level of cash that we've been at in many years. I think we were like a little more than 40% in cash. And as time moved on and as the picture started to change, I could see what was going on. I then was able to go out and to buy back some of these companies and other stuff. So the cash position has been drawn down a bit. So I've sold and I've bought. The end result is that we're ahead of the market right now. I think yesterday we're slightly less than half or double what the market's doing at this time. So I'm very happy with where we are. And what we want to do is to, smooth out performance. So I don't have a whole lot more to tell you other than you see what's going on. I'm going to pass it over to Andrew so that he can help you.
Thanks, Dad. Yeah, our macro and micro styles, they really do fit like a glove together. The my ability to look deeper into the companies and the nitty gritty of what's going on there, it leads to us having better conviction on the things that we buy and sell for your portfolios. It's led to better performance overall in a tangible way. We've had different life experiences, so we don't always agree, but that's okay. It leads to us making better decisions because we get two people to voice opinions about things, and we end up in the same place at the end. So my thoughts on the economy right now, it's there's kind of two economies going on right now. It's what's called K-shaped. There's what's going on Wall Street and in business where there is just an absolute ton of tailwinds. Everything kind of looks rosy. There's a ton of money being spent on AI data centers and on electrification of the power grid, and banks are lending money to businesses at pretty cheap rates, and private companies aren't having trouble raising capital so that they can keep growing and expanding, and that all leads to Wall Street and stocks going up. But there's the second side to the economy, which is more the Main Street side. And Main Street for the last couple of years has been struggling a bit more. The inflation's been up, so things are more expensive, and budgets are tighter. And it plays in with the barrel of oil because if oil remains elevated for long enough, those prices don't just stay at the gas pumps. They do, and that's a tax on the economy, but they also get passed off into everything gas is used to get places, which is everything. And so, if people's needs, their food budgets and things go up because it costs more to transport things to places, less wants might get bought. And consumer spending is like 70% of GDP. So, if we end up with sectors of the economy that end up having less people buying things, you could see kind of a sympathetic, modest downturn that occurs because of it. It's not something that I would, overly worry about. There's no real structural risk in the economy right now that are the things you usually would be scared of. There's no financial system about to collapse or anything like that. It's really just one of those opportunities that you would get to go and be brave into people's fear and take advantage of the opportunity to snap some things up cheaper than they normally would be and ride the growth back up and end up performing better over the long run. So that's my thoughts. Dad, do you have anything else to add?
Well, yeah, you're right, Andrew, and you got to realize that these things are only you don't see the effects immediately. What you see is the numbers start to show up maybe 2, 3, 4 months down the road. The effect of the price of a barrel of oil because we have such tailwinds right now to the economy. This is kind of the only headwind I see. So I'm not sure if we're really going to get a big bad issue from it, but I do think it's going to affect it, and any effect's going to have people maybe take a step back because markets are pretty frothy. So I want you to understand that that's what we're doing. We're taking advantage of what's happening out there. We have plenty of cash to work with. We're not as high as we were literally just a few weeks ago, but at this time, we've got plenty of cash we can go buy with, and that's always a good thing. So I'm going to wrap this up and tell you that we'll see you at the end of the second quarter, and you have a wonderful next quarter. I can't wait to talk to you again.